Macroeconomic Update, June 2020. In the month of June 2020, Indian equities ended with strong gains driven by optimism around pickup in economic activity from the bottoms seen in April 2020. This was partly offset by the risk of a second wave of COVID-19 infection, clash between India and China over territorial dispute, etc. In the fixed income markets, the 10-year G-Sec yield rose, driven by overhang of large supply of government securities, but the credit environment improved with spreads of corporate bonds easing to a certain extent. In other major developments, Moody's downgraded India's sovereign rating from Baa2 to Baa3, while maintaining the negative outlook. Fitch Ratings placed India's rating on negative outlook, while reaffirming the rating at BBB-. S&P reaffirmed the rating at BBB-, while retaining the stable outlook. Thus, India's rating by all the three rating agencies is now at the same level. The spread of COVID-19 continued to remain a concern, with the number of infected cases globally rising to approximately 10.6 million as on 30th June 2020 from 6.3 million on 31st May 2020. In India, though the number of positive cases continues to rise, the proportion of such cases were relatively low considering the large population. The total infected cases in India reached approximately 5,86,000 as on 30th June 2020, up from approximately 1,90,000 cases as on 31st May 2020. As the economy is reopening and restrictions are relaxed, Indian economy is witnessing early signs of pickup in economic activity. While traditional data comes with a lag, few activity indicators like power demand, goods transported by railway, unemployment rate, etc. are showing improvement month on month, and pace of contraction has significantly reduced since April 2020. However, some consumption indicators like sale of cars, two-wheelers, diesel, etc. continue to remain weak. While the impact of lockdown will be felt most in H1 FY21, we believe that H2 FY21 is likely to be significantly better provided the spread of COVID-19 is contained to a large extent. India's Q4 FY20 current account turned into slight surplus, a first after 13 years. Improvement was driven by the improvement in remittances and services exports, along with stable trade deficit. The balance of payment also remained healthy, with FPI outflows more than offset by higher FDI inflows, increase in external commercial borrowings, and rise in NRI deposits. The outlook for current account and balance of payment in FY21 remains comfortable, with fall in oil prices and weak domestic demand likely to result in contraction of imports. While exports and remittances are likely to weaken too, on an overall basis, India's current account might remain in surplus for FY21. Significant shortfall in tax revenues, both direct and indirect taxes, resulted in the centre's fiscal deficit widening to 58.6% of budgeted estimates in the first 2 months of FY21. Transfers to states remained high despite shortfall in revenues, as the centre continues to transfer the amount based on budget estimates rather than actual revenue collections. Capital expenditures grew at a healthy pace, while revenue expenditures contracted slightly. Fiscal deficit in FY21 is likely to be significantly higher, on back of contraction in revenues because of weakness in economic activity and impact of announced fiscal stimulus. IIP contracted sharply by 55% in April 2020, being impacted due to nationwide lockdown. This was driven by broad-based fall in all sub-segments led by capital goods, infrastructure goods, and consumer durables. Impact of lockdown and phased resumption of production is likely to keep IIP under pressure in the near term. Like in April 2020, due to difficulty in data collection and limited number of transactions, full data related to CPI was not released for May 2020. However, data of some subcomponents, mainly consisting of food, housing, health, etc., was released. The limited data suggests that food inflation has softened on back of easing vegetable prices driven by lower supply disruption. However, inflation of other constituents of food index like pulses, meat, edible oil, etc. remained at elevated levels. While inflation in the near term can remain at elevated levels due to supply-side disruptions, it is likely to moderate in H2 FY21 on account of base effect, weak aggregate demand, and normalization of supply. Commodity prices ended the month higher on back of optimism around recovery in economic activity, especially in the US and China. Brent crude prices continue to grow at a healthy pace, driven by production cuts and revival in demand. The impact of lockdown is likely to result in India's GDP contracting in FY21, a first in the past 40 years. However, growth rate should recover in the second half of FY21 as the situation normalizes. Fiscal and monetary measures announced should also provide impetus to growth to a certain extent. Growth rate in FY22 is likely to be significantly higher due to low base and absence of disruption caused by lockdown. While the immediate impact of disruption is negative, but once the situation stabilizes, India stands to benefit in the medium term, in our opinion. Amongst the emerging markets, India is better placed as most major EM economies have high dependence on global merchandise trade and/or are net oil exporters. Thus, weakness in global growth and fall in oil prices are likely to hurt these economies significantly. But India is a net importer of oil and stands to gain significantly due to fall in oil prices. Further, India's dependence on exports is relatively limited as compared to other EMs. Thus, once the situation stabilizes, India could see relatively stronger recovery. Further, disruption in global supply chain caused by this event has highlighted the risk of overdependence on a single country. Thus, over the medium to long term, many global MNCs are likely to consider diversifying their manufacturing operations from China. India could be a likely beneficiary given the low corporate tax rate, skilled population, relatively low wages, and a large domestic market. For more on this, please refer a mid-year update on the Indian economy and markets, published in June 2020 and available on our website www.hdfcfund.com. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.